Our guest today is someone that I've known for a couple of decades, Roland Kelly. He's been in-house for over 20 years, having recently made a switch to Velocity Financial to serve as their general counsel and corporate secretary after a long career at Jefferies Financial Group, where he served as the right hand to the general counsel with the title of managing director, associate general counsel, and assistant secretary. Roland has a unique background because Jefferies also had some major subsidiaries, one of which Roland served as the de facto chief legal officer and chief compliance officer. I'm Brock Romanek, today on Zippy Point. So Roland, how do you define materiality in this item 1.01 context?
Well, materiality has always been defined under SEC rules as well as case law. And it's a fact and circumstance test. And basically it's whether or not a shareholder would find the information to be meaningful. From an issuer's perspective, what does that mean? You can guess all day long, is a shareholder going to find this interesting or meaningful? But you really have to take a step back and look at what in the past has moved the company's stock price. That gives you a sense of what investors consider significant or meaningful. What have analysts written about? That gives you an idea as well. Quantitatively, you can take a look, and SAB 99 details this really well, taking a quantitative as well as a qualitative view of an event or an amount. There's rules of thumb people have used, 5%, 10%, but really it's just taking the information, viewing it in the context of all the other information that the issuer has publicly disclosed, and really making a determination of whether or not a shareholder would find the information to be significant.
And for those of you who don't know, SAB 99 is Staff Accounting Bulletin number 99, and that's guidance that the accounting staff at the SEC has put out that is closely looked at when you're making these materiality judgments.
Now, Brock, one thing, I'm sorry to interrupt, but one thing that I found to be particularly useful as in-house counsel is, why does somebody not want to disclose? So oftentimes we'll either enter into a contract or an event will happen and management or somebody is leaning towards not disclosing it. And so what I like to do is ferret out the reasons why. And that can oftentimes lead to a better reason to disclose it. If management thinks it could be embarrassing, for instance. Oh, well, embarrassing, that means that a shareholder probably finds it to be significant. So I oftentimes like to find out whether or not management is opposed to disclosing and then finding out why they're opposed. But more likely than not, people really are just there, leave it up to counsel to determine whether or not something has to be disclosed. And in that sense, we always try to err on the side of caution, and we would rather disclose than not disclose.
You have to put your persuasive powers wristbands on. Not easy being the in-house lawyer, being the no person, for sure. So how can you tell an ordinary course contract from one that is not?
Yeah, that's another good question, especially given the background of the companies that I've worked for. Some of the companies that have one industry, it's very simple. Have we entered into these types of contracts before? It's black and white issue. Sometimes though, like for instance, Jefferies, they're an investment bank as well as a merchant bank, meaning the latter part, meaning that they buy and sell assets and companies. So what might be material to, let's say, just a pure real estate company may not be material to Jefferies because it is constantly buying and selling various different types of companies, or entering into various different types of agreements because it has so many different business lines. So the real question there is, have we entered into this type of agreement in the past? If the answer is yes, then typically that's ordinary course. If there's something different, or if it's something that we've never entered into before, unless it's clearly immaterial, then it's usually falling on the side of not ordinary course.
How about the schedules? Oftentimes material contracts will have a bunch of schedules, and some of it will be a bunch of gobbledygook. Some of it could be hard to Edgarize, so might be hard to get into the SEC's filing system. how can you tell which ones you can omit? I know that the SK item that I talked about earlier in this video talks about a immateriality standard.
Right. So really, thank goodness that this new rule or has been adopted, because before, especially an acquisition agreement that has 90 different schedules, it is a pain in the butt to Edgarize. So thankfully, you're allowed to omit immaterial schedules. So really, and it goes back to drafting these agreements. You need to draft the agreement with the mindset of put everything material in the actual agreement. Don't throw it into a schedule. And that way you don't have to worry about omitting the schedules. Oftentimes what people I have seen do is put a lot of the material things in schedules and think that they can omit the schedule, but that's not what the SEC is allowing these days. So it's clearly, in order to omit it, you really have to have a reasonable basis to believe that there's nothing material in those schedules. And in fact, it's even a lower or higher threshold, I guess. It really can't be, it really needs to be immaterial. So I think personally it's a different threshold, materiality versus immaterial. But that's just me being cautious, probably.
There's that gray area in between where that falls into the quasis, the pseudos, that you can fall onto one side or the other. I definitely agree.
Right. But like I said, it really, I think disclosure counsel should be involved in the transaction to make sure that if something is iffy, they can just push it into the agreement, or alternatively, just disclose it in the body of the 8K. Say that when you're describing the agreement, you can throw in whatever you think may be not quite immaterial. You can put in the body of the 8K itself and then omit the schedule.
So let's bring your 20 years of in-house experience to bear. Can you walk us through what you see as a typical process to vet contracts to determine whether they should be filed with the SEC?
Yeah, sure. So typically, as chair of the disclosure committee, we've set up our disclosure controls and procedures to make sure that myself and the general counsel are always involved in any type of material or any contract or transaction that could be deemed to be material. And so the general counsel and myself will discuss first whether or not this may give rise, do we need to do an analysis? So we'll take, again, SAB 99, quantitative as well as qualitative views of the contract, looking at whether or not we've done something similar in the past. Oftentimes it's just a no-brainer. We know that this is material and it's going to be disclosed. It's those gray areas. Sometimes it's just entering into a financing, for instance, or a sale of assets that are right on the verge of being material that you really need to look at and talk to finance, for instance. How is this going to affect, or treasury, how is this going to affect our cash flows, liquidity? Is this going to cause, something that we need to disclose in MD&A? Oftentimes, if we know that there's going to be MD&A, management's discussion and analysis of a contract, we'll most likely, because of that, we'll file it as a material contract. And again, it's just fact and circumstance. It's really knowing the business, knowing the contract, and then making a determination whether or not you think shareholders are going to find significance in it.
So let's talk about signatures. It's become a pet peeve of mine because I recently got takeout here during the pandemic, and they required me to touch someone's pen that everyone's touched to sign something, which my signature at this point in my life is just a scribble, which I'm sure most people's are. And so the whole concept of signatures to me seems so outdated. But here where you have contracts that you're filing as exhibits, how do you Edgarize a signature?
From the very beginning days when I left the SEC, I've always just put a /, typed a little S or / and typed the name of the person who signed. So I think they call it conforming the signature. So basically I take the actual document that somebody signed and I just type it out.
And then how about the exhibit index for, so, this video is about 8Ks, but then you're going to incorporate by reference this 8K into your periodic reporting stream, your 10Qs and your 10Ks. How do you keep track of these 8Ks? You'll have 8Ks under item 101 more frequently than most of their items, perhaps other than item 202, for the earnings releases. But how do you manage your process, or when to update those indexes in the periodic reports?
Right. I'm laughing because it's kind of funny. With a company we took over, I took a look at their exhibit index, and they had contracts from 10 years ago that clearly no longer applied. So obviously somebody has to be tasked with the responsibility to review that index table every single quarter. And that's my role, unfortunately. And so I kind of go through this script, if you will. I just refresh myself. Go on Edgar, look at all the 8Ks that we filed recently, and make sure that we have everything that we need to have. And then I'll take a look at what we actually disclose. Are there any material contracts that we can remove now because they're no longer material and there's no longer any obligations under those contracts? I, again, just kind of look at it from, are there any compensatory agreements that need to be added? And I kind of just do it that way.
Do you hate that process?
Sometimes I do, because it forces me, there was a material contract that was filed, and I'm no longer servicing that area of the business. I have to go bug other people to try to figure out, is this contract still in existence? And do we still have obligations under the contract?
Yeah.
So it's a thankless task, but somebody has to do it.
Killing contracts can be hard off the index, for sure.
That's the other thing, it's easy just to let it ride for another quarter. And sometimes nobody wants to take the responsibility of saying that, yes, you can remove it.
Exactly. Thank you so much, Roland.
You're welcome. Thank you.